Welcome to the Profit Answer Man, Cashflow Mike. It's great to have a conversation with you today.
Are you kidding me? I am with the Profit Answer Man. There's nothing but answers coming out of this session. You know that.
I know that. Can you share a little bit about yourself and your business?
Yeah, hey, my name's Mike Mylan. I'm also known as Cashflow Mike. I live in San Antonio, Texas, and I have a program built specifically for accountants and bookkeepers where I not only teach you the cash flow concepts that you can easily do with your clients and explain it to them, but I also have a certification program that gets you prepared to provide cash flow advisory services for anybody that you work with.
All right, so now I'm a little confused. I would have assumed accountants would know how to talk to business owners about cash flow and profit and explain it to them.
Yeah, actually, I think they do. I think a lot of accountants and bookkeepers they actually know how to talk about profit and talk about cash flow. But here's what I found: the only reason I've done this is that there were two problems that kept popping up every time I talked to an accountant and bookkeeper. First, one is that they said, "Hey, this advisory services thing isn't going away. It keeps getting pushed at us from every angle. I don't care if it's a software provider, if it's any of the industry leaders or thought leaders around, but they're all saying it's coming. So we need to figure out a way to move from transactional accounting or compliance accounting to more advisory services. And we're a little scared, right? There's no playbook out there where you can just drop in step by step and be able to go, hey, this is how you do it from A to Z. So that was the first problem. The second problem is, even though they might know a little bit of it, they're still lacking some confidence, right? Like, how do I really do it? I haven't had to give as much advice, do the math and give advice. So how do I do it? So those are the two things I focus on specifically, is giving you the skills, which also gives you the confidence, and then giving you the step-by-step playbook on how to set it up in your company.
Can we make fun of them?
Everybody. Yeah. You can make fun of me.
You know what? Because I look at their business and they work too damn hard for too little money. How are they going to tell anyone else how to work less and make more?
Well, I tell you what, I mean, it comes down to speaking the language of business owners, right? And that's dollars. When you start talking about financial impact, what it costs you to be the way you are instead of the way you could be, that's the bell that always rings in the head of the business owner. I mean, so I've got the tools and I think a great program to be able to help you convert some of the language that we use, liquidity, solvency, leverage, all this stuff that nobody else understands, into financial impact of dollars to get their attention and help them, create action or take an action.
I never use those words. What we do is we talk about how do we take action today to have more cash in your pocket tomorrow.
See,
That's it. It's that simple.
yeah, see, you don't need me.
So, well, yo, hey, I learned from everybody and I learned from you. So, how do we find hidden cash in the business?
Well, first thing you got to look at is, a thing that I call clearing the noise. When you look at your financial statements, I mean, they're packed full of everything that we've put together, the chart of accounts, every little thing, I mean, that you've done. The income statement is just a report card for the month period or quarter or year. Balance sheet is really the culmination of every decision we made. The cash flow statement is the, difference between the two periods. But when you find hidden cash, you have to get all of that stuff out of the way and focus on what matters. And there's two categories that matter the most. The first is cash generating activities. How does money actually come into it and what do you do with that money? And the second is cash conversion activities. How fast does money move through your company? When you look at those two together, you can create what I call a cash leak map, right? And this cash leak map focuses on those two categories of activities, either how money comes in or how money goes through. And the combination of those two actually points you to where the biggest problem is, so you can focus your time on fixing that problem.
And usually there's a problem, and if you're good at knowing how to look, it becomes very easy to find.
Super easy. I mean, I can find hidden cash in a matter of minutes. With 8 numbers, I can take 8 numbers from your income statement and your balance sheet and convert them to a financial impact cash leak map in a matter of less than 5 minutes.
Is that something we can explain easily on this podcast?
I think so. I mean, all right. So the three cash generating activities is you do three ratios basically. It's sales to assets, gross profit margin, and net profit margin. And from there, what we're doing is we're comparing ourselves to one of two things or both things. One is what we could be, the other is what we should be. What you could be is what your own goals are. What should I be, or what could I be if my gross profit margin wasn't 30%, it was 32%, right? So that's the could be. The should be is how do I compare to the industry average? When I say should be, that's the minimum. When I say industry average, that's a C player. So I'm going to compare myself to the industry average, right? I don't want my clients to be C's. I want them to have A's and B's in business, right? Instead of C. So when I look at if the industry average is 30, I want to at least be there. That's my first hurdle. So those are the three cash generating activities: sales to assets. How much assets or how much revenue do I produce with my stuff? Gross profit margin is how much money do I got left after I've made a sale. And then net profit margin is how much money do I have after I've paid all my expenses. So that's the first three. The second three: inventory turnover, AR turnover, AP turnover. How long do things sit on the shelf? How long does it take your customers to pay you? How long does it take you to pay your vendors? When you compare the could be and should be to those, you can create a financial impact. What would I look like if I was just better? If I was at my own goals, or if I was at my own, or if I was at the industry average? So, does that help? Does that explain a little bit?
It does. The first three are kind of from the income statement. The second three are kind of from the balance sheet.
Yeah.
And what they are, and this is where I think people get it wrong. On the balance sheet, people look at the balance sheet static. Balance sheets need to be read from month to month. And it's those changes in AR, in inventory, in those different things, truly what's important. And what I find is no standard report shows you the differentials.
Somewhat, right? Because
Yeah,
I look at the cash flow statement as exactly that. The cash flow statement is the tattletale of the business. It tells on you. And what it does is it compares the changes in all of those. When I teach somebody how to read a cash flow statement, the first thing I start with is it's built from the changes of the balance sheet. So I actually go through and talk to people about how that cash flow statement is actually put together.
and I think part of the thing is most people use QuickBooks. When I've looked at the cash flow statement in QuickBooks, it doesn't seem to give me the data I want
Well,
in a way that's easy. I don't know. Maybe I just need to look at it differently. Um,
no, I think you're right. I think if you can do a comparative period on the balance sheet from QuickBooks, right?
yeah.
If you just period over period, I think those changes are important. Well, what you're looking at, where I think QuickBooks wouldn't do, is tell you is it a source or is it a use of funds of cash? When you see a change, we'll say in AR, if accounts receivable goes from $1 million to $800,000, it's a negative. You're going to see a change as a negative, but it's actually a positive. It's a source of funds. You actually collected more money. So where I think QuickBooks probably gets it wrong from the balance sheet side is it will show you as a negative, not actually that you've collected money.
And that may be, I always found it was easier to do my own stuff. And so I just pull the data out of QB and then I run my own stuff versus using their reports. I just found that report was difficult to. Part of it also could be that not everyone does a great job of updating their QuickBooks. And so you don't always have good data to start with, right? Garbage in, garbage out.
Sure.
So it could be that. It varies. So the second part is you've got the book, The 7 Minute Conversation. What do you talk about in that? Like, what are we having in this 7 minutes of conversation?
Well, let me back up on why it even exists. Right, this 7 minute conversation. At one point in my life, I was running 5 LLCs under one reporting company. Right, so I had a hotel staffing company, 3 bar restaurants, and a property management company. And I needed a quick way to kind of just say who's in trouble, right? Which one of these companies needs my attention today? So I came up with a technique, a methodology that touched all the bases. You're like, what does that mean? Well, that's why I started nicknaming it the home run financial system, because it touched all the bases. It was a little bit from the income statement, a little bit from the balance sheet, and a little bit from the cash flow statement. It's 6 calculations that actually tells you where your biggest problems are, because it's going to focus in on some very important things like trends and EBITDA from the income statement. It's also going to focus a little bit on expense control, meaning, are you cutting enough expenses when you should be at the right time? It's also going to look at a thing called debt to equity from the balance sheet and mismatch financing from the balance sheet. When I bought something, did I use the right type of credit? And then lastly, it's going to interpret the cash flow statement for me and just tell me what happened. Because remember, the cash flow statement is a tattletale. So it's just about interpretation of what happened. Where'd your money come from and what'd you do with it?
So let's talk about this one, because I think that was one of the biggest ahas I got from you, is appropriately tying financing to the type of asset in the length of time that you're going to own that asset. And I don't know how many people actually take the time to look at that. In other words, I don't want to take out a 30-year loan on a work truck, because the work truck isn't going to last 30 years. While
Mm.
my payment might be low, I'm going to get myself in trouble with that. At the same point, I can't buy a building on a 5-year loan because I probably can't afford the payment. But there's probably a lot of these types of things that happen in between.
Yeah, the thing you're describing is what I call mismatched financing, right? It's using the wrong loan product to buy something, and believe it or not, the estimates say there's 60% of small business owners out there have some type of mismatched financing. And what it does, it's a silent killer of business because it sucks cash out of the company in the form of interest, right? It just higher interest. Hey, I'll give you an example. I mean, would you buy a house with a credit card? Yeah.
No, unless, well, I could pay it all off in a year and I got a 0% financing.
Yes. See? There
I
you go.
doubt that though.
Yeah, but most people can't do it. But you wouldn't do it because wait a second, you'd get great miles. Can you imagine the miles you get if you did that? But anyway, but reason why you wouldn't do that is because short term credit typically is more expensive, right? I mean, you're talking 20 some percent now on a credit card, and you're talking 7%, as we speak on a mortgage, right? That difference where people are just making their payments, the reason it sucks cash out of the company is that you're just making the payment and you're not paying attention to the interest. Well, the technique you described was, how do you avoid that? How do I avoid mismatch financing? And the rule I tell people is that the length of the loan should match the life of the asset. And here's what I mean by that. If I can depreciate something for 5 or 7 years, then I should buy it with a 5 or 7 year term loan. Because when the benefit of depreciation stops, so do the payments. And it's a good time to either replace or think about something else. You don't have a lot of things that are overlapping or money that's hanging out or depreciation that's wasted. You're actually matching the life of the asset, the amount of time it's supposed to generate revenue for you, with the length of the loan. It's a perfect way to avoid that.
And that makes a lot of sense. Again, it really sucks when you have lots of payments and the truck's gone or no longer useful, right? Because,
That's right.
I mean, you don't feel that day one, you don't feel that year three, but all of a sudden at year six, eight, and 10, that stuff starts piling up and you do start to feel it when you have that mismatch going on.
Yeah, but here's the thing: if you can identify, right, and I teach in my course, The Clear Path to Cash, how to identify mismatch financing. And if you can identify it, you can save people hundreds of dollars per month, right? With not taking on new debt, just restructuring the debt into the right place, right? Taking it off of the credit card or off of the line of credit and putting it into a term loan. And I'm gonna tell you what, no business owner ever walks out of the house and says, I'm going to misfinance my company today, right? It's just, so you just don't do that. It happens so fast, you don't think about it. I mean, it happened to me. I bought a cooler that had went out at a restaurant. I just jumped in the truck, went over to restaurant supply, put down the credit card, bought a cooler, and at the same time, mismatch financed my company. Why? Because I can depreciate the cooler and I put it on the credit card and I just let the balance run, right? So I was paying all that interest when I didn't have to.
Well, you go do something because you have to do something in the moment, And then you got to come back and deal with the issue later, which is searching for the right financing, talking to your banker. But then I got busy and then this happened.
Exactly
That's
right.
life, right?
Yeah. Well, I mean, if you don't mind paying thousands of dollars extra in interest, I guess it's not worth your time. Because it wasn't to me. I found out about this later. It was too late. That cooler was already paid off by the time I figured out that I had done it.
And, I think that's one of the things, though, because if you think about it, and this is getting a little technical, the interest is on the P&L, the principal's on the balance sheet. And most people aren't looking at the balance sheet, so they're not noticing that cash leak. Because people will be like, "My P&L says I made money. Where's my cash?" Well, it leaked over there in another part that you didn't see. And so I think sometimes they just may not even realize what's going on.
Yeah, I think that's important, right? That's why I talk about a concept called the financial gap, right? And the financial gap is the difference between money coming in and money going out. And and people look at these things in silos. They look at how much inventory is sitting there, or how much I got going out in payroll, or how much I'm got in AR, or how much in AP. Well, these things happen simultaneously and they overlap each other. The difference between inventory sitting on the shelf and AR waiting to be paid and you paying your bills is called the gap. And the reason why I like calling it a gap is because the smaller the gap, the easier it is to run your company, where it doesn't feel so clunky. Whereas, oh, I'm always waiting to get paid before I can do something else. So when you learn the calculation about the financial gap, you also know the levers you can pull to make it smaller. And when you make it smaller, it takes less money to run your company. And so you're not seeing it on the balance sheet because that's where it's leaking, right? That's where it's happening, is most of the time on the balance sheet. So I think it's really important what you just said there.
And I think more often than not, people just don't know. And that's what I was kind of where we started with the conversation, that there's no one report, I think, that gives you the total picture. You kind of have to learn how to read all the tea leaves of the different reports. What you've done is kind of put it all together in your system so that you can read all the different tea leaves in one place in a way that's easy to understand.
Yeah, I'd like to think that, right? I'd like to think that, we found a way to help people do these things quickly, and the tools point to the answer, right? That's one of the hardest things is my whole complaint with my CPA back in the early 2000s was, great, now what? Right? Which is, I see that you can do math. I see you can do these ratios. What do I do next? Nobody could answer that question. So I've taken my system to go beyond just what it is to what do I do next? Right? That's the most important part.
That's why they pay me, because I show them what the levers are
There you
and I
go.
show them how to move them and which lever is going to take the least amount of effort and provide the biggest return for them. And so
Hey,
that's kind of the goal.
right on. And I wish everybody thought that way, right? I wish that every accountant, bookkeeper, or even business owner, if you're a business owner listening to this podcast and you want answers, I'm telling you, take the time to understand what lever you can pull at what time, because that is where you're going to get the biggest impact and put more cash in your pocket. And I call that transferable wealth, using your business to transfer wealth from that to you, which funds whatever you want to do next. Retire, go on a trip, doesn't matter.
That makes sense. So you actually come from a banking background, kind of, or
Kind of. It depends on how far we go back, right? So here's one of these
here's
things.
the question.
All right.
The question is really, how do we talk to the bank? Because I don't think most business owners know how to talk to the bank.
Got it. Got it. So first of all, I'll clarify, I've never been a banker. I've trained, I have trained over 20,000 bankers, from Wells Fargo all the way down to Hills Bank in Iowa. I've trained over 20,000. I have taught at the graduate school of banking at LSU, Colorado, Pacific Coast Banking School, taught how to do small business banking. Because of that, I was able to crack the code, so to speak, give people like us, the accountant, the bookkeeper, the business owner, a way to speak banker language, right? So I think what I've done is be able to create a way for us to deal with a banker, right? Understand what they're doing, because it's embarrassing when you walk in there and they're talking about ratios, or they're talking about how debt should be structured, and we're not really aware of what they mean or how they would want it to be. So, just for an example, I mean, three of the easiest ratios that I can, or four maybe, I can just tell you the answers to, right? Nobody ever tells you the answers to the banking test. They'll tell you, they'll tell you everything about you need this, that, or the other, but they don't tell you the answer. What should it be? So, like a current ratio is can I support my own business this year? Can I support my own business? And the way the balance sheet is set up, and I'm teaching a little bit, and I apologize for that, but the way the balance sheet is set up is that current assets are supposed to pay for current liabilities. The sale of your fixed assets is supposed to pay for your long-term liabilities, right? They kind of work independently that way, because current assets and current liabilities are what I call variable. They tend to move with sales where fixed assets don't, right? So if that's the case, I should have enough money in my bank account to pay for, we'll say my credit card bills. And that's how I talk to most of my clients, is they don't understand current assets and current liabilities. So I give them an example, which is, hey, current asset, when I say that, I want you to think checking account. Current liability, when I say that, I want you to think credit card. So if you see a number 2, if somebody comes up to you and says, hey, you got a 2 as a current ratio, what they're really saying is, for every dollar you owe on the credit card, you got $2 in checking. And it tends to make them understand it a little bit better. So a current ratio, you want a 2, right? I've just told you the answer to the banking test. You want that number to be 2 or higher. So that's one of them. I mean, what do you think about that as a way to educate a client?
I think it's great. Part of the problem, and I just had this conversation with a potential client today. If you don't have a good chart of accounts and you don't have good data in your QuickBooks or whatever accounting software, you're not going to have real numbers. And honestly, I would bet 80% of business owners don't have good up-to-date numbers in their QuickBooks. Meaning, if I went in there and I looked, like, when are they last reconciled through? Have they even been reconciled? Does QuickBooks match the bank? Or does QuickBooks say one thing and the bank say another thing? And even with the credit cards, like, oh, my credit card got disconnected. The bookkeeper's been screaming for 2 months for me to send them statements. That's the world I see a lot of. And I think that's one of the bigger, I think this is why the biggest complaint I hear from bookkeepers is that business owners don't value them or the work that they provide. And the reality is, if you don't have good numbers, you can't do what you just did in 2 seconds. No, I'm in a good place because I have twice as much cash in the short term as I have debt in the short term.
Yeah, so I may have had a different experience. I'm not saying that the data is good. I just work well. I mean, because everybody on the podcast would go, "That's dumb, Mike. You're wrong." But I still have the same clients as everyone else, right? Where they're behind, it's not cleaned up, it's
Right.
categorized wrong. I mean, you name it. Here's what I can tell you: I go ahead and do the technique anyway. I still
Oh,
do the math. I just do it anyway, because then when it looks really wrong, they start correcting me. They start saying, "Oh, well, yeah, but we forgot to do this." They start seeing why the data is wrong. I'm like, "Well, it looks like you're really crazy. I mean, you're way out there. I mean, nobody's going to do anything with this company, right?" I just do a technique where I analyze whatever they give me. They see how wrong it is. They start to see, "Oh my gosh, I need to clean this up because that number could be better if I do this, that, or the other." So I let them self-correct just by showing them how bad their data really is.
see, I'm always learning.
Hey, I'm not here to to push somebody into it, but if you show them how valuable, like the hidden cash thing we talked about earlier, if I show you that and it's some astronomical number, you can go, "Oh, they won't believe it," right? If I say there's $50 million in your hidden cash in your business, they know there's not $50 million, but they do know that the data is probably bad. But they're more interested in having a realistic assessment of their business so they can see what's actually there. They now believe in the technique they know the data's bad, so they're willing to work with you to clean it up.
And I know, I mean, that's the reason you're here, because I know your techniques are phenomenal. I very much enjoyed reading the book and going through it and saying, this is simple, it's easy, it gives you the answers you need. But then I meet people.
You know, Rocky, I mean, there's that famous quote that says, "No plan ever survives first contact with the enemy."
Yeah, well, it's fine. Well, at the end of the day, this is why I think I love Profit First so much,
Simple.
is because it's simple. And for most business owners, they don't have to open up their QuickBooks. They don't have to do ratios. They can look and go, I got cash. And, whenever I look at my bank account, that amount of cash makes me feel okay. Right.
Mhm.
Or they look in there and go, whoa, there's no cash. I got to do something quick. Payroll's coming Friday. So it's just, you know, I, I think what I will say, what you do is phenomenal. It's what I call second order. The first order is, you know, get your cash moving in the right direction so that you can start to think and make it work for your benefit.
I can tell you what, I'm a fan of Profit First, right? I mean, so much so that I partnered with them. I mean, there is not a program out there that I think blends as nicely with what I do as Profit First. I mean, and mainly because it is a process driven methodology that anybody can do at any stage of their business, right? And so, whether or not you want to take a look up front with my stuff or after Profit First, both of them work together. Just kind of they're seamless. I mean, I even use Relay in my own business. I mean, that's how committed to Profit First I am.
And this is where I think people get it confused. They think, oh, I can only do this or I can only do that. Most of these different things all stack on top of each other. So you can use Profit First, you can use Relay, you can use QuickBooks, or you can use another accounting software. You could even use an Excel sheet, depending on the size of your business. You can use your system. All of these things are not this or that. The more of these systems you stack together, the better and better you become, the more knowledgeable you become. It's no longer a question, can I afford this employee? It's, hey, you know what? I can afford this employee. Here's where the profit to pay for it's coming from. Here's the cash over here, and here's how it's all going to work out. And this is how much I need that employee to generate in revenue to break even.
Yeah, I like to describe what you just said as it's just a Lego set, right?
Mhm.
If I give everybody the exact same Lego set, just X number of blue and X number of red and all those type of things, we're all going to come up with a different picture. Different, we are. We're going to have the same tools, but we're going to stack them together a little bit differently. That meets our style. That meets our needs. So I like that.
Is there anything that we should have talked about today that we didn't get a chance to?
Well, that's a good question, right? So I I think the best thing is about doing something and finding ways, and I'm going to reiterate this sentence to clear the noise, right? Clearing the noise to me is the biggest thing because every time your client talks to you, or as a business owner, every time one of your customers or employees talks to you, there's already something going on in their head, right? They're already thinking about something else. So if you come to the table with a plan and they're thinking of something else, that's noise. You have to give them the opportunity to get that away so you can really engage with them. The way I do that is at the beginning of every single conversation with my clients. I will say something like, "Hey, what's been going on in your world? We haven't talked in a week or two." And it gives them the opportunity. You know what they tell me? Whatever burning issue they have, and that's where I start, is right with what their problem is.
And I agree with you because that's usually what I ask before I go into all the things that I have on my agenda is what's on your agenda and what's most important to you, because it until they are heard and until they can deal with what's top of mind, they're not going to listen to anything else,
Yeah,
right?
that's right.
And when you're struggling with cash, the rest of the stuff doesn't matter. You've got to get your cash moving, just like you need oxygen to breathe. If you can't breathe, nothing else matters until you take that breath. And
Hear
I think
that?
The same thing is true of cash in the business. You got cash in the business, everything else is figure outable.
Yeah, totally agree with you, man.
If people would like to learn more about you, your books, your programs, where do they find you?
Yeah, super easy. If you can remember the nickname Cashflow Mike, just go to cashflowmike.com. I have two different courses to choose from. One is the Clear Path to Cash. Oh, look at that. We got balloons. Clear Path to Cash, which is the technical concepts that I teach to be able to use with your clients or in your own business. The second one is the Pathfinder program, and that's our certification program on being able to implement and execute an advisory services program focused on cash. So, two different choices on courses to get you started. I would start there. If you need something free as a resource to just dip your toe in the water, go to cashflowmike.com, download the ebook, The 7 Minute Conversation, to get more about what we talked about today. No problem.
And most of our listeners are business owners. And I think that last resource is perfect for them to be able to just go get the book for free, start thinking differently, make yourself more profitable.
There you go. Appreciate it.
Thank you so much for joining us. Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.